Hello and welcome to Money Matters. As new regulations come into various sectors, the stock market is seeing some uncertainty, and choosing stocks can feel like a bit of a gamble. Tonight, our two stock pickers give us their top choices as they go head to head.
Two new challengers go head to head this month. Veterans Dickie Wong and Francis Loon offer some punchy portfolio power picks. Dickie's first stock is China's Geely Auto, stock code 175. He says the company has been a fixture in the mainland auto market for decades, making traditional fossil fuel burning internal combustion motors. But the Hang Seng Index component company seems to have seen the light, most likely an electrical spark, because it started to invest heavily into producing a new line of electric cars, or NEVs, as they call them in China.
They probably will roll out a new brand C-car as early as in the first quarter of next year. And Geely Auto's mother company, Geely, they're also the owner of a very well-known Sweden automaker, Volvo. And in the longer term, I believe that this company, along with other like BYD, they will have some kind of like robust growth, not only in the original ICE cars, but also EV cars.
Beijing has ambitious emission reduction targets and has backed these policies up with generous tax incentives for people to purchase NEVs instead of the emission-spewing polluters of old. Geely already commands a strong position in that market, but it's looking longer term these days.
I think they can have a very big piece of the whole market of EV cars because they have the technology and actually they can sell cars through various channels.
Geely reportedly announced that it would invest over $23 billion into research and development of NEVs, and set a goal that 40% of its output would be hybrid or electric by 2025.
Chip shortage definitely is one of the key things that happening everywhere in the world. Not only those Chinese automakers are facing now, but basically the German makers and also the US makers, they're facing chip shortage. So in terms of the chip shortage or the boost, robust price of the chips, it may limited the production and also affect the overall supply chain. And also, like, if the chip price keep going up, it may also hurt their earnings ability.
Dickie sets a target price of $28 and a stop loss of $23. Dickie's second choice is closely related to the emergence of a healthy NEV market. In fact, the product that Ganfeng Lithium produces is present in almost every single electronic product made today.
Battery-grade lithium products producer, one of the largest in the world. And in the past couple of months, its share price went up quite significantly. And also its earnings, because like from the third quarter and also from the last 9 months, the earnings went up like more than 500% and 600% respectively.
Dickie expects the company to maintain its staggering rate of growth over the next 2 years.
Most of the EV producers, they still need lithium-grade products, no matter what kind of battery they're using. Lithium is one of the key ingredients of the batteries, so they still need that.
All batteries?
All batteries, basically. Not limited to automakers' EV batteries, but basically every batteries, including cell phones.
Dickie says the main risks to the company are connected with supply chain bottlenecks in the post-pandemic manufacturing world. But the risks are not limited to these issues.
These companies, even after the share price pullback recently, it's still trading at a very high level in terms of PE multiple. So these are two main key factors, risk factors.
Dickie sets a target price of $160 and a stop loss of $128. Our other challenger, Francis Loon, also likes Ganfeng Lithium. Francis associates the lithium market closely with the EV car market, particularly the rise of Tesla in China.
With the full swing and transformation from gasoline and diesel cars to electric cars, lithium becomes a precious commodity. And of course, the price of lithium hydroxide or phosphate more than doubled within the last year.
As Tesla makes its own batteries, it's just signed a 3-year contract with Ganfeng to supply the company with lithium. Francis says the deal guarantees its profits will continue to rise for at least the next year. He feels the risk factors are roughly the same that Dickey identified: a high forward valuation and snags in the supply chain of chips and raw materials that could disrupt production and lead to an earnings glitch if customers can't get their hands on their favorite Tesla model. Francis sets his target for Ganfeng at $180 and a stop loss at $120. Speaking of chips, Francis reckons any chip shortage will be accompanied by a spike in prices as companies compete to get their hands on a key component in all modern manufacturing. Price volatility plays into the hands of makers like Francis's second pick chip maker SMIC, stock code 981, and the largest chip maker in China.
This year, there is a global shortage of chips. It affected everybody. So chip prices have gone through the roof. As a result, SMIC reported spectacular interim profit of 3.3 times last year. Wow, that's $846 million US dollars.
SMIC and its competitors are in the amazing position of being able to sell the production of an entire year and next. Francis says the shortage won't disappear anytime soon.
Setting up a foundry costs you 10 billion US dollars, and maybe it will take 1 full year or 2 full years lead time. So the global chip shortage is here to stay.
And on top of the shortages benefiting SMIC's performance, to everyone's surprise, the U.S. government approved export licenses for both SMIC and Huawei, both of which are under a trade ban with U.S. suppliers of high-tech components.
It shows that Biden is more interested in profit for U.S. manufacturers.
Francis says as the U.S. can throw SMIC billions in export licenses, so it can take them back, and there lies the main risk to SMIC. Francis sets a target price of $30 and a stop loss of 18. We'll review Francis and Dickey's stock picks in 1 month to see who will return to go head-to-head. Hong Kong-listed Link Real Estate Investment Trust will acquire 50% stakes in 3 retail properties in Sydney, Australia. Link said it had agreed to pay $398 million to IPO Property for 3 retail assets in the heart of Sydney's central business district. The buildings are Queen Victoria Building, the Galleries, and the Strand Arcade. The acquisition will be funded by debt and cash, and Link's ratio of debt to total assets will increase to 21.4%, based on its financial position as of March 2021. Tesla chief Elon Musk has run afoul of regulators with his latest Twitter poll proposing to sell 1/10 of his holdings in the electric car maker. The tweet shaved around $60 billion off of the company's market value. Musk tweeted that he would offload 10% of his stake if users of the social media network approved. The poll garnered more than 3.5 million votes, and nearly 60% of the people voted in favor. Musk's poll follows a proposal by U.S. Senate Democrats to tax stocks of billionaires to help finance President Joe Biden's social spending plan. Musk had previously said he would have to exercise a large number of stock options in the next 3 months, which would create a big tax bill. Selling some of his stock could free up funds to pay the taxes. Musk may have violated an agreement with the U.S. stock regulator that ordered any of his material tweets to be vetted by lawyers before posting. Chinese real estate developers and banks have reportedly held meetings with the think tank of China's State Council in the southern city of Shenzhen. The meeting comes amid intensifying worries over a liquidity crisis in the country's property sector. Reuters has reported the meeting included China Vanke, Kaisa Group, Ping An Bank, China CITIC Bank, China Construction Bank, and CR Trust. Stricken property giant China Evergrande Group has rattled global markets as it grapples with large debts that investors fear could pose systemic risks to the financial system.
When we come back, Money Matters returns to the property hunt amidst a slump in prices. Are sellers cutting their prices? Find out after the break. Welcome back to Money Matters. Hong Kong's residential property market saw a price rebound in the first half of this year. But the border with the mainland has remained sealed, and that's had an impact on the market. Prices have slipped for 2 months in a row. And yet, Alice Khan reports that some homeowners in the central and western districts have kept their asking prices where they were before the slump.
Conduit Road in western mid-levels was constructed in 1910. Because of its long history, the buildings found here are older than those found in the newer central mid-levels area. Reality Gardens was the original location of the Foreign Correspondents Club. It was also in the 1955 film Love is a Many Splendored Thing. Currently, there are only 4 blocks of relatively new buildings located here. In 2015, a duplex flat at 39 Conduit Road sold for $595 million, or $103,000 per square foot, making it the most expensive apartment in Asia at the time.
They're still very close to the central area. It's from here to about 10 minutes driving distance from Conduit Road to the central CBD area. But it's, on Conduit Road, there's a less density and a more open area.
It can also be reached by the central mid-levels escalator. Currently, property prices here range from $20,000 to more than $100,000 per square foot, depending on the building's age. Government data showed overall home prices decreased after they peaked in July, and luxury prices dropped by 1.5% month-on-month in September.
The demand has also been, decreased due to the border opening issues. In the past, quite a lot of the investors, especially home investors, are from the mainland China. And of course, there are also some investors which are from the overseas countries. In case the border has yet to be reopened, that means in the market, most of the buyers are the local people. And in Hong Kong, most of the local buyers are the occupiers instead of the investors.
This week, we looked at a flat in this 6-year-old property. It has 12 stories, offering 35 units, with sizes ranging from around 1,500 square feet to over 2,600 square feet. Asking prices range from $52 to $130 million. The apartment we visited is this 1,494 square foot flat. The owner is asking $75 million, or $50,000 per square foot.
Is it reasonable?
I would say it's not cheap. I would say it's a bit higher for the market price, since the seller to have a confidence in the property market.
As always, the condition of the flat determines its value for money. The living and dining area is 364 square feet and can accommodate a lot of furniture. The dining area can fit a table for 8.
You can put some display cabinets, so no problem.
And here is the living area.
This is a living area. You can put, I think, 6 up to 8 people maybe sit a sofa in here. And since it's a very still a long distance from both walls, you can put a big, probably bookshelf on this side, and some display cabinets or TV cabinets on this wall. 364, yes, just for this session. For nowadays, those you can divide the 2 studio flats for some new building.
The ceiling height is 10 feet 7 inches, higher than older buildings in the area. It has a large floor-to-ceiling window in the living room. It also has a balcony.
It's a quite big balcony. You can put the chairs, some small table in the balcony. Then you can use as doing reading, drinking wine.
But the flat's main room faces the mountain.
Some staircase over there. What's that for? Does it belong to this estate?
Yes, this slope belongs to this estate. This staircase is for maintaining the slope of over there. You have to carry inspection for the slope as required from the government.
Next, we checked out the 3 bedrooms.
And this is the first bedroom.
Well, there's a corridor here. Then, how big is this bedroom?
It's about 100 square feet.
But this corridor already take up like
25. Take up about 25 square feet here.
But here it doesn't got much space for the bed.
Unfortunately, you can't put the king size bed, I think, but you can turn this room into a guest room and also study room.
Next is a 150 square foot ensuite bedroom.
Well, this room also have a corridor. Is this waste of space?
It won't. It has a special purpose. For example, you can put a wardrobe here. It's big enough to wide enough to put a wardrobe, and plus it's very high ceiling, so you can build a height and big wardrobe here. And also this is the bathroom door. So for the bedroom, you won't see the bathroom door if you have a corridor here. So also to keep the bedroom more present.
The sleeping area is not small, and it has a large window. It has a decent-sized ensuite bathroom, too. The master ensuite bedroom is 220 square feet. It has a very large floor-to-ceiling double-glazed window onto a green view. It faces the southwest, so it is warm in the winter.
It's quite easy. You could put a bed here. It should fit the king-size bed easily and still have a room to walk around the bed. And you can put a cabinet, a little cabinet there for the TV, something like that.
What about this area? This area is also, what sort of furniture you can put here?
I would say you can put a wardrobe. For sure, or simply can put some of working desk in this area to treat as working area in this session.
Well, it also has a small balcony here.
Yeah, it's good. So it's good for circulations.
The ensuite bathroom is 80 square feet. The size is similar to some master bedrooms in new buildings. It has 2 sinks, a shower, and lots of storage.
It's not just bathtub, it's a jacuzzi.
Oh, and also there's a TV here.
Yeah, it's a waterproof TV, so you can watch TV when you're taking bath.
The bathroom is also nicely decorated.
The buyer can save time and money to redecorate the flat if the decoration suits them. And also there's not much TVB in this unit.
At last, we checked out the kitchen. It is 100 square feet, larger than the usual kitchen in regular buildings.
Do have lots of appliances, which is quite attractive to the expat, since they like cooking quite much. And then also about 30% of residents are expat in this building.
The flat appears in good shape, but the owner may take a while to find a buyer at the current price amid the poor sentiment in the property market. After a long day pruning grapes in a vineyard, 33-year-old independent winemaker Ian Dai finishes his last batch of harvests for the year on the desert foothills of China's northwestern Ningxia region. China has grown grapes here since the 80s. The industry has been heavily influenced by the French methods of viticulture. Dai's current goal is to find grape varieties that can represent China on the world wine market.
China is big. I want to explore the terroir of China. So put it in a romantic way, I want to explore terroir in China. I want to figure out how different region tastes like, feels like.
He's experimenting with less industrial ways of winemaking, with little manipulation, such as adding yeast or adjusting acidity and tannin levels during fermentation. Dai's first batch of his own brand sold only around 5,000 bottles in 2018. But in 2020, that number increased to over 20,000. He expects this year's total to be over 30,000.
As a winemaker, I should have an ego to make the best wine in this planet one day in the land of China with a grape we grow in this land. So I think in 20 or 30 years' time, I should make an interesting wine, and it's also super good in international standard. It should be compete with top wine in the world.
Of course, the wine market being about wine, there's always a sniffy attitude about new producers breaking through to compete with European and New World products. China's wine market is the 6th largest in the world. The forecast is for $18 billion in sales by 2023. One bright side of the pandemic, travel restrictions have forced China's wine lovers to explore domestic vineyards, raising awareness. As Chinese embrace new varieties of grapes, experts say it's only a matter of time before the wine of Ningxia earns more consumer support.
That's the show. Thanks for watching. Next time on Money Matters, we discuss what impact zero COVID policies may have on business and the economy. See you then. Good night.